Okay, Matthew, thanks for joining our interview at the Digital Asset Yield Summit. Today we will just high level discuss the industry, how SharpLink's strategy applies to it, what are the bottlenecks in the industry. So yeah, it will be pretty easy going conversation. So I'd like to start our conversation with the question about the 2026 in crypto. What events do you see on the market, and how is SharpLink's strategy applies to them?
Yeah, so SharpLink, being a digital asset treasury focused on the Ethereum space, is very much looking forward to the tokenized equity growth and real world assets that we think really unlocks post Clarity Act. But honestly, I don't think the Clarity Act is a prereq. I just do think that it will be a catalyst for an increase of velocity. So, one of the big things with Ethereum historically is that it is closely tied the value of the network and the value of the token. And so, we look at high quality assets secured, and the rough relationship between high quality assets secured on the Ethereum network and the bottom end of the range for token value has roughly maintained a 1-to-1 relationship. Now, we don't think that's possible going forward, because we do think that we're going to see a hyperbolic growth in on-chain assets. Like Larry Fink in their earnings call last year, he said that they were going to tokenize everything. I do not think that if we went from 30 billion of real world assets to 4.5 trillion because iShares tokenized, that we're going to all of a sudden see that growth occur in the Ethereum price overnight. That being said, if you go from 300 to 4.5 trillion, I do think you're going to see material appreciation. And that's just one firm, one provider, and one set of funds. So that's the thing we're most looking forward to. We're excited to engage with the ecosystem and help those things grow, to help provide liquidity in ways where it's accretive to shareholders. And I think that Clarity is a major catalyst, the Clarity Act.
Yeah, nice. Can't agree more. I have, since you mentioned about the DAT, maybe 18 months ago, maybe 12 months ago, roughly, there was a ETH DATs boom. Yeah, a lot of DATs launched, and some of them are not doing good at the moment. They're closing down. My question is, how do you see this ETH DAT or DAT sphere overall? Is it affected by loud but unsuccessful dissolution of some DATs? How would you just describe DAT industry as of now? How credible it is? What's developing?
I think it's a great question, really topical. So in 2025, we were the first Ethereum treasury to raise. We pivoted our strategy over to Ethereum accumulation end of May, beginning of June, raised around $3 billion of equity capital to purchase Ethereum. In that time since, around 195 companies have put digital assets on their public balance sheet. And while we had time to hit escape velocity, and we went in with the benefit of a long time to plan the strategy, a lot of folks raced to market, not just in Ethereum, but in a long tail of other assets. And as a result, they didn't necessarily have a plan for what happens when it isn't just a pure euphoric market, right? That was never part of the SharpLink strategy, to be fair. We're looking to be a linear accumulation vehicle. We're looking to make our Ethereum productive. That's one of the best things about being an Ethereum treasury is you have native productivity and you have the financialized productivity that people who are familiar with strategy already understand. And native productivity element doesn't really care about bullishness in the market, right? We're going on chain, deploying in what we think is a safe way to try to generate additional yield. But we hit escape velocity. We have a full-time team dedicated in-house to the deployment of our treasury in a high-quality institutional way. A lot of the treasuries that raised funds in Q3, Q4 didn't have enough time before the market collapsed for them to hit that escape velocity. And now they're stuck in a difficult position. I have 100 million, I have $200 million worth of insert token here, sometimes Ethereum, but most of them are not. What do I do? How do I go and create a compelling value prop? And what we're seeing is a lot of them pivoting away from being a pure play digital asset treasury because the economics just don't make sense. It's not a wide enough capital base. They're doing things like selling their tokens to buy operating companies. They're doing things like investing in minority shares of media companies. They're investing in minority shares of gaming companies. There's a lot of things that are interesting. We don't view it as a negative though. We think that you have a menu of options And as long as you are very articulate about what your strategy intention is in advance so that the market can understand what they're investing in, the more options, the better. We just want good operators out there doing what they say they're going to do. I think it's great to have a variety of options because at the end of the day, the entire equity market is built around the idea that you can give someone dollars to implement a strategy and hopefully generate you more dollars. The DApp market is just saying you've decided you want to be long this token. We're going to go and try to denominate our P&L in that given token so you can accumulate more of it. There's not one strategy that necessarily makes sense for everyone. As long as those operators are doing things in good faith, we're very happy that they're there. I agree with you though, there's the least common denominator effect, and the guys who didn't have a plan, who aren't doing anything, are, I think, dragging a bit of the industry down from a perception perspective. And those of us who are trying to break out, I'd say, by getting the message out that there is a difference.
Nice. Very insightful. Thank you. You touched base on yield on ETH. So what strategies are you doing? What strategies are you investigating? So tell me more.
Yeah, so the way that we think of it is we have a ETH portfolio and you have the Ethereum staking rate. If you think about what an efficient frontier of risk reward looks like, the staking rate should roughly be the y-axis intercept. That is the almost zero, but technically non-zero risk rate of return that you should consider to be the benchmark. And then everything you do thereafter should be seeking higher risk reward to stay above or on that efficient frontier. The thing is, the market really hasn't defined the efficient frontier yet in DeFi. It's barbelled itself. There's a lot of very low risk, very stable, what is considered to be blue chip DeFi strategies earning a little bit in excess of the Ethereum staking rate. And then there's a lot of very high yield strategies, think venture capital, liquid VC, discretionary, long, short, things like that. And high risk isn't necessarily bad. They're generally higher convexity, higher return, but the convex thing that we are making a bet on is Ethereum already. People are looking for us to generate them additional Ethereum per share, and that's our North Star, ETH-per-share. So all the yield strategies we're exploring, the idea is principal preservation and consistent. So we're looking at things like Calmar and Sortino, like drawdown ratios, as opposed to purely maximizing for headline yield. So one of the things we did very early on was we went 98% native staking because we just wanted to show the market what does it look like to make Ethereum productive on a public balance sheet. And we were making around $1 million a week native staking. And then we said, okay, great. Composability is one of the most important things in the Ethereum ecosystem. Let's go and move roughly a third into liquid staking tokens so that we have the optionality to make our portfolio composable in the And then we went and did an industry first. We did a 2-year deal with our partners at EtherPi, EigenCloud, and Winium. We said, we're going to deploy $200 million into your liquid restaking token. We're going to bridge over to Winium. We're doing that for 2 years. And it's a brand new type of deployment because the industry is not used to having duration outside of venture capital. We're not looking to generate venture-style returns in ETH. We're looking to have ETH be the return generator, and we're looking to generate what we think like singles, doubles, and triples in ETH-denominated terms on top of it. In addition to the on-chain incentives you're going to earn from any other liquid restaking deployment, we also are getting compensated from each of those 3 partners for providing that 2-year duration. You can kind of think of it as almost like a TVL deal in that respect, except we're not this short-term mercenary capital looking to come in, farm incentives, and leave. We're looking to partner with the best in the industry, give them capital so that they can deploy it over long time horizons, and then generate returns in excess of the Ethereum staking rate in exchange for defining that new kind of term premium. So we've done deals like that. We've told the market we're exploring more active strategies. We find vaults to be extremely interesting, but we're not going to rush into anything for the sake of a headline. We've told the market we find OTC strategies, off-chain CeFi strategies to be very interesting in the Ethereum denominated. We're going to apply the same level of rigor that we do to every deployment. And we're not going to do something for the headline's sake. That being said, eventually you paint that efficient frontier starting at native staking, moving your way all the way out to higher risk, higher reward in smaller quantity strategies. You try to have the variance as low as possible so you can kind of paint like a long-term sustainable ETH-denominated return profile.
Nice. That's a great answer. My next question on the strategies. In April there was total of I read recently 20 plus hacks for 700 mil, and of course the significant one with Kel Player Zero and Aave. How these events affect your kind of risk reward appetite?
I wouldn't say that these events directly changed anything because we were already taking a very conservative posture to our deployments, and it can take us months sometimes to get through the due diligence to make a deployment. It did validate a theory we had, which is that the market was overly barbelled and that it was putting too much emphasis on what was considered low-risk DeFi, but in reality, it was just low-yield DeFi, not low-risk DeFi. And I don't think that the market necessarily was commanding a significant enough risk premium for its actions. Like, at the end of the day, people were getting paid below the Ethereum staking rate for a small amount of liquidity premium and a considerable amount of protocol risk. Now, I don't want to Monday morning quarterback and say we 100% would have identified this. We did have a list of criteria. There were things about that deployment that would not have met our criteria. But at the end of the day, it is all about being active and updating your scorecard anytime you get new information. One thing we do is that we have not made a deployment outside the qualified custodian. And that's a really important distinction. It's not to say that the QC is this like pillowed room that ensures that nothing can go wrong, but it is a very rigorous set of standards. And like, so when we went to our QC, we're like, okay, great. We want to go and do this deployment. We want to mint a liquid restaking token. We want to go and use a bridge. Can we do this from within the QC? The answer originally was absolutely not. The QC is where you buy tokens and we go put them 15 stories underground in a vault. And if you give us enough notice, we can get them out for you, right? Like, and we challenged that with our very collaborative partners. We said, no, the QC is where the highest levels of institutional trust are built. And it's where you have a second set of validation on the criteria that you are actually doing something smart and reasonable. It took months, but they ended up going to OCC and we got approval to do this deployment without leaving the QC. We're going to continue to try to do that. Like we like to say that we're not going to lower to the standards that the industry currently tries to say are legitimate. We instead say we're going to define our bar, and until someone's able to get over it, we're just not going to assume the additional risk because we don't think it's the right risk reward. We're going to continue to try to do that. It's not just good for us, it's good for Ethereum, because when you own $2 billion worth of ETH, like you want to do things that are good for shareholders and you want to generate additional ETH-per-share. You also want to do things that are good for ETH because you own a lot of it. And so like after we did that deployment at UC, everyone else was able to go to that same custodial partner, do the exact same deployment. They didn't get paid those first mover incentives because we have to spend the work to do it. But now we've unlocked a brand new segment for institutional DeFi. If we can keep doing that, we can unlock a lot of things, raising the standard instead of compromising.
Yeah, agree. And I liked your take on low yield DeFi.
Yeah, there's a difference.
That's a good way to put it out. So like last 12, 18 months were like significant and good for crypto in terms of macro. Let's say ETFs taking approvals, this DAT arised. Like it was positive. Like a lot of TradFi players are really entering crypto and actively developing. So what from your perspective, what's still blocking? What's the bottleneck in the industry, and how do you see it can be solved?
So what I would say is that we spend 24/7 thinking about these on-chain problems because that is what we've decided to dedicate our time to. Investors are not necessarily going to be able to dedicate the same amount of time that you are to understand these problems. And if they can't fully make sense of what their deployment looks like, what their exposure is, it enters the world of black box. And investors, at least traditional financial ones, don't like black boxes with the exception of very performative HFT and quant strategies. And that is not what DeFi is yet offering. What it's offering is actually the most open and transparent, but difficult to understand for someone strategies. And so what we like to do is we like to take these concepts that are quite complex and try to make it as digestible as possible for our institutional investors. Every time we do a new deployment, we're trying to introduce one new layer of complexity, not just because we're oftentimes the first person ever doing it at public companies. So our accountants, our auditors, all of our partners have to get up to speed and ensure that they're comfortable with it. We also have to then be able to walk these institutional investors along for it and say, hey, we just did this. Here's why we did it. Here's how we think about it. Here's the risk rewards and the way that we think about it. Here's how you keep track of it, etc. And so it's not that it's necessarily a blocker, but I'd say there's a large learning curve if you want to do this right, because you could go and implement a very complicated market neutral on-chain portfolio, the same thing that you might have in your personal account today, working out of your MetaMask wallet. But then tomorrow, your largest investor is going to call you and say, I have no idea what I'm holding. And they're no longer going to want to be exposed. And because SharpLink is trying to be that institutional bridge between DeFi and TradFi, I'd say our largest blocker is ourselves and our ability to almost get the institutional allocators up the curve alongside us, doing it without compromising those standards. And that means our auditors, that means our investors, that means our partners. And that's kind of the game that we're excited about playing every day. And that's why talking to folks like you is actually really great, because every time we do this, someone else learns a little bit more about what institutional DeFi looks like.
Yeah, that's true. So one of my last question would be, what's your 2026 crypto hot take? Let's make it controversial. Controversial 2026 controversial crypto hot take.
I'd say my controversial take is that at these conferences, a lot of people like to tell you how they built exactly what TradFi needs, and they try to shove it down your throat. And the problem is you for not understanding how great the product they built is. In reality, traditional finance is very good at defining qualifications and defining requirements, and you have to build what they ask for. And so I think a lot of the products that exist today were good for DeFi 2.0. They're not necessarily good for DeFi 3.0, which is institutional grade. I think that people are going to have to come to terms with that and just take the product feedback to heart, because in reality, it's a first to plant the flag type situation. The reason why someone gets a large contract when there's 10 different providers offering effectively the same thing, from what someone can tell, not necessarily being close to the industry, is that they're able to meet the product spec perfectly. So I think we're actually entering into a world of bespokeness, and that the companies that are willing to build exactly for a specific customer requirement, they're the ones that are going to win the game ahead. Because right now, we built the best thing in crypto and we're just looking to sell it to you. You should take our word for it. We're so large, therefore we're good. Mentality doesn't work for TradFi. It works for digital asset natives who understand who you are, who have heard your name, who have seen you at every conference for the last 10 years. These TradFi guys have no idea who you are. Your reputation does not precede you. Get humble again. We're trying to get humble. And I think if we all humble ourselves down and build exactly what they asked for, we're going to do a lot better this year.
That's a great take. Matthew, thanks for joining, and enjoy Consensus.
Thanks. Appreciate you having me. Cheers.
Cheers.